All right. Another day. I'm going to give you a few more seconds for some people to come in and get this live show going. Just bear with me. All right. I think we're live. I'm going to turn on Instagram. Just give me 1 minute. There you go. All right. Welcome, everybody. This is Mike Patel with Home Savvy Central. I'm in Southern California. If you're coming here for the first time, welcome. And if you're coming back, second, third, fourth time, we welcome you. We have great topics to discuss every week on Tuesday. I usually bring experts and guests to my channel. And today I have a special guest. But before I introduce the guest, I want to introduce you the topic today. And the topic is there are massive mortgage crises, prices are dropping, and housing crash begins. How true is that? And how false is that? So we're going to dissect that. And we're going to talk about affordability. We're going to talk about foreclosures. We're going to talk about high home prices. We're going to talk about low home prices. So we got a lot to discuss today. We have a very interesting, very current, very trendy topic. So I'm glad you're here. I'm glad you're joining me. If you're watching this as a recording, thanks for watching. We've got some great information to help me discuss these issues and concerns and the trends. I have with me my special guest. He's been here several times, Paul Sian. He's from all the way from Cincinnati. He is an attorney. He's a realtor. He's an investor. He's got a wealth of knowledge. So welcome, Paul. Introduce yourself to our guests in your way rather than my way. So,
well, thanks for having me, Mike. My name is Paul Sian. I'm here, Cincinnati, Ohio. I'm licensed both in Kentucky, work mainly in the northern Kentucky area, just south of the border here for me. Few like 5-10 minute drive for me, and then a lot in the Cincinnati area, which is kind of a larger, we could call it the greater Cincinnati metropolitan area.
Right.
It's the greater portion of our housing inventories on the Cincinnati side.
Right.
So I've been doing this for about 15 years. I'm also an attorney as well as well as a real estate agent. So I've been also practicing law, real estate contract law for also a number of years as well too.
Mm-hmm. So, cool. Nice.
Yeah.
Okay, cool. Very nice. I just want to let you know I'm excited today because I'm just going live on Twitter for the first time. And I'm also trying to go live on Instagram. So a lot of exciting things happening. My channel's growing. My viewership is growing. So I'm trying to bring in more guests and more viewers. So we're on a lot of channels today. Hopefully we'll grow more. So let's get right into it, Paul. I know this topic sounds negative, but we're not trying to be negative. We're not coming and saying, oh, market's going to crash. But let's look at the facts. Here's fact number one. Home costs 52% more than pre-pandemic or during the pandemic, while wages have only risen 18 to 22%. We know that has been a concern, right? Home prices have appreciated, since 2010. Let's look at the last 5 years, 2021, 22, 23. They've appreciated anywhere from 10, 20, 30%, most of the areas. But the wages are remaining the same or not increasing that much. And that has created and will create more affordability crisis. When it comes to buyers want to buy and sellers who are not selling or want to sell, where is the difference, or what's halting the number of sales of home sale, which is not increasing that much? In fact, it's decreasing. What's your opinion on that?
I actually got a pretty recent example too. I had a seller who was listing his property. He's pretty fixed in terms of his price, didn't want to move much. So we put it on the market for a month or two just to see, what kind of bites he got. So not much traffic. His neighborhood isn't one of those hot neighborhoods. There's a couple neighborhoods here in Cincinnati as well where, assuming it's priced right, you'll get a lot of people and you will get multiple offers. But then there's other neighborhoods where it's, if the price is too, pardon me, if the price is considered too high, right, then those buyers are be like, I'm going to wait. With the current mortgage rates and the current prices for homes, it doesn't make financial sense for them. So they're just sitting back. And at the same time too, sellers as well, if they need to sell and they need to buy another house, then they're also looking, well, the inventory is kind of tight. If I sell, where am I supposed to move to?
Right. Exactly. Yeah. So let's look at this slide here. This slide is from Investopedia. And let's see what they're saying. This came out on July 2nd, 2025. So it's very recent. Home buyers can only find affordable houses in 3 of the biggest US metro areas, which means that all other areas they can't afford it. And that's what's happening. I mean, sellers are putting their homes on the market. 40% of all the home sales this year have been delisted, which means they put it up for sale, but then they backed off. So 40% of all the homes have been delisted. More than 50% of sales, maybe it's 45%, have given concessions to the buyers, which means they gave closing costs or they gave repairs or they gave down payment assistance, which they didn't give 2 or 3 years ago. The seller's attitude was, hey, take my house. It is as it is. Take it or leave it. Now they've changed the tone. Like I said, 40% took off their homes, and more than 50%, I think it's 45 to 50%, gave concessions. Is that a cause for concern, or is it just normal market? What do you say on that?
Yeah, I think the market's shifting. It's now, in the past when we had a seller's market where the sellers could command, they got multiple offers usually within the first day. A lot of buyers are waiving inspections. They're waiving, even appraisals, coming in with very strong mortgage pre-approvals if they're doing that, or paying cash.
Mm-hmm.
So these days it's quite the opposite. It's, a lot of sellers are sitting on the market for, longer than that average, and then wondering, hey, what's going on? How do I, they're probably blaming their agents as well too. Hey, you're not marketing it enough too. And you and I know, as agents who've been around for a while, you can do a lot of marketing, and that's true, but ultimately it comes down to price. And so when the buyer's not willing to pay your price, no amount of marketing is going to help that home get sold.
Absolutely. You can have an overpriced home and you can do open houses every weekend. You can run ads in every major paper. Did I say paper? I meant online. It's not going to sell because buyers are very smart today. Buyers already know they're paying a higher price. And if the price is already high, they're not going to pay a higher price. So they're going to tell you, the seller, take a hike, and they're going to find something else, because guess what? Down the street from you, there's another house, because inventory is up, what, Paul, about 20 to 40% on average, depending on where you are compared to last year.
Yeah, it's still low in some parts too. I mean, I know over in our areas, it's lower than general.
Mm-hmm.
But it is starting to peak, and we also get into a colder season over here.
Okay.
So as we get some, we'll get an occasional snow, and the temperatures drop down to the 30s
Right.
and 40s. So fewer people are wanting to go see houses. Fewer sellers are wanting to put their house on the market too. Same time too, it becomes more challenging when let's say you sold your house, and even if you want to move to an apartment, when you sold that and you need to moving in the winter months is not fun. Nobody likes to do that.
Yep.
So a lot of the housing slows down during the winter time frame, and then again it'll start picking up again in the spring.
Exactly. Yeah. So let's look further into this affordability crisis that we have, that's causing a slowdown in homes, but they're not dropping the prices. So it's kind of a little confusion here. But what Investopedia is saying, this article is saying, the key takeaways: home prices are currently at a record high. As a result, the median American can only reasonably afford to buy a house in just 3 of the 50 largest metro areas. A typical person must make at least $117,000 a year to meet the standard affordability benchmark of spending 30% or less of their income on housing. By the way, the average household income right now in USA is about 85,000, but they need about 117,000 to buy a house to keep their PITI, the principal, interest, tax, and insurance, at 30% threshold, which most lenders want, and which is best for the owners, because you don't want to stretch all your paycheck or pay 50% of your paycheck to the housing cost. The next thing they say is, because wages haven't climbed as fast as housing prices, many Americans are moving to more affordable areas. It's becoming harder for Americans to find a home they can reasonably afford to buy on their income. This is also leading to more people are renting. It's cheaper to rent. I read several reports. In fact, I did a video a couple of weeks ago where it's in more metro areas, it's cheaper to rent these days for the next few years than to buy. Have you come across that, Paul, or are you seeing that in your area? Or
Yeah, it is. It makes sense, and in a lot of areas, it is happening a little bit in our area too. That there's been a lot of new apartment inventory that's being put up in Cincinnati area.
mm-hmm.
Actually, I mean, not necessarily a resident side, but I noticed that on my son's side, he rents an apartment for his university.
Uh-huh.
So the university put up a lot of not them specifically, but they had a lot of private developers come put a lot more buildings up. And as a result, his rent actually went down, which surprised me. I didn't expect the rent to go down from last year to this year, and they gave him free parking too, which was a great deal.
Yeah.
You're seeing that more and more, not just in even university towns where they've overbuilt and student enrollment might be dipping down due to the high price of tuition.
Right.
I think everywhere there's been this big surge of building all these multifamilies, and even in our area, we've got a nicer suburb over here, and I think they've put in at least, I want to say 500 to like 700 units plus.
Right.
So I know the one is probably still has some vacancy. That's the little older, just completed a couple of years ago, and this brand new one just opened up, and they're just starting to rent out. But that's going to put pressures on rents as well as, and then, if you're paying a higher rate, on your mortgage, buying a higher priced home, then it's probably going to make much more sense to go rent. I mean, with a lot of that too is, if your furnace goes bad, call the landlord. They'll come out and take care of it.
Yep.
You're in a house and the furnace goes bad, guess who you're calling? You're either going to fix it yourself if you have the skills, which most people don't, or you're calling an HVAC technician who's going to charge you a pretty penny to fix it.
Yep. Yeah, absolutely. And the other thing is, look at this report that came from, let me see, where is it? It's from the National Association of Home Builders. What they're saying is that nearly 75% of U.S. households cannot afford a medium-priced new home in 2025, which is around $440,000. And as we mentioned earlier, you need about, let me read the article. It'll tell you what we need. This came out in February 2025. It says here that housing affordability remains a critical issue, with 74%, which is pretty much 75% of U.S. households unable to afford a medium-priced new home in 2025, according to National Association of Home Builders' latest analysis. With a median price of $460,000 and a 30-year mortgage rate of 6.5, this translates to around 100 million households priced out of the market, even before accounting for further increases in home prices or interest rates. Of course, last week the rate is down 6.29%. It might have dropped again yesterday or today. But even then, I would say maybe instead of 75%, maybe 70% cannot afford to buy a house today. So we're kind of in a pickle because we have so many listings out there. Listings have gone up, the number of homes for sale compared to last year. Historically, we're still very low, but compared to last year, in some areas, they're up 40%. In our area, we're up maybe 10, 15%, but in certain areas, it's up 40%. And still homes are not selling. Sellers are taking off the homes off the market and not selling anymore because buyers just cannot afford to buy homes. Only 25% of the households can afford an average priced home, a medium priced home of around $460, where in California, where I'm at, the medium home price is $1 million or 1.2. New York, San Francisco, Chicago, Miami, Dallas, home prices are way higher. Florida, some areas, Cape Coral, homes are 800, 900. So we have a big issue here. And that's why we're saying, are we going to see a housing crash? And I'm not saying that we are, but will this lead to it? Here's my thought. And of course, it's only a thought and might be what 2 cents, maybe what 10 cents. But the home prices have been going up since 2010. It's been up and up and up and up for the last 15 years. It has never happened in the history, from what I read, in the history of USA. There's always a cycle. It used to be 7 to 10 year cycle, go up and go down, go up and go down. But this time it has gone up for 15, 16, 17 years. And they're saying that on average, home prices will go up until 2026, 27, maybe by not much, by 1 or 2%. So does that mean that the crash is coming in 27, 28, and this may be a nasty crash? I mean, I don't know. I mean, what's your thought, Paul, based on what you read or talk to other people?
Yeah, I mean, it's a great question, hard to predict. I think one of the things is with recently the inventory has started ticking up, as you mentioned earlier, and it's still pretty low. So there's not a lot of home sellers out there. They're not necessarily desperate. I think if home sellers really get desperate and they start just undercutting their price in order to get it sold, then the buyers might step out from the corners there and say, okay, yeah, I'm interested. But for the most part, buyers are kind of sitting on the side. A lot of sellers are sitting on the side, so it's kind of at a standstill. So
Yeah.
I don't think you'll see anything, movement price wise if the sellers aren't really selling and the buyers aren't buying.
Right.
If the sellers aren't dropping their prices, then the prices are, they'll kind of stay where they're at there, because that's
Yeah,
how we.
sellers are in a denial. What's happening is, one, they're sticking to the higher prices, and the buyers are not buying. That's why there was a 40% of homes that were delisted.
Yep.
Then what's happening is, because I work with canceled listings, expired listings, I keep up with what's going on locally and nationwide by talking to other agents, because I belong to a network. But what's happening is, these sellers, once the house is off the market, a lot of them are saying, in fact, I talked to one seller today. His house came off the market a couple of weeks ago. And he goes, you know what? I tried to sell my house. I got a couple of offers, and he's in Santa Ana, which is about 10 miles from here. But I changed my mind, because when I found the house that I liked, which his house was listed for $750, it was an older home, 3 bedrooms, 1 bath, really old, built in the 1940s. That's why it's so cheap for $750. He said, I found a buyer. We got a great buyer. But when I went to look for homes, I found great homes. But when they charged me 6.87%, he said, yeah, backed off.
Yeah.
So what's happening is, the sellers are finding homes, but they're cringing at 6.8, 6.5. Maybe if it drops to under 6, maybe they'll budge. And I asked him, how long will you wait? And he was a young guy. He was, if I had to guess, he was about 40 years old. He said, I don't have to sell my house. My house is older home. Worst case scenario, he's going to add another bathroom, add another room. So he said that. So what's going to happen is, you've lost another home coming on the market, and one of the other sellers that he was going to buy is not going to buy.
Yeah.
He's going to hang in there, build an ADU, because now in California, like other states, it's legal to build ADUs, or accessory dwelling units. They allow you to build another unit in your backyard, or you can do an extension, and it's very easy for the city is giving permits easily than 3-4 years ago.
Yeah.
So this is what's happening. So I don't think the market's going to move a lot. Inventory is still going up, but it's still historically low. That's what I have to conclude. So
Yeah, it's a challenging time for both buyers and sellers.
Yeah. Let's see what this report says, the NAHB. It says, this analysis also highlights the effect of rising cost. A $1,000 increase in the median price of a new homes would price an additional $115,000 households out of the market. Just $1,000. Imagine that. A 25 basis point rise in 30-year fixed mortgage rate from 6.5 to 6.75 would price approximately 1.5 million households out of the market. But guess what? This article came out in February, but on Friday, the rate drops to 6.29, and I believe today they dropped again. So let's say it dropped to 6.15. So we got another 3 or 4 million home households who can afford. But guess what? Yes, they can afford it, but they're not paying the higher price. So if you're priced at 460 and the comparables are at 440, these buyers are smart. They're not going to pay you. So as a seller, you have to be very, very cautious on how you price it, because buyers are smarter than before, right? I mean, they know everything. They go to the websites, they talk to lenders, they talk to realtors, they know what they want, they know the condition. So if you're not priced right, if it's not presented well, if it's not marketed right, it's going to be a deal list. You're going to be in the 40% where homes are being delisted.
Yeah.
So let me stop this screen and share another article. Okay, yeah, that's one thing I want to share. Let's see. Just give me 1 minute. Share screen. We're still talking about, this is from Joint Centers for Housing Studies, and this report came out in January 2024. So I'm dating this, but this was an issue in 2024, and it's worse right now. It says here that the home price to income ratio reaches record high. In 2022, the median sales price of a single family home in the US was 5.6 times higher than the median household income, higher than that at any point on record dating back to early 1970s. This represents a rapid increase in just a few years. as home prices have risen considerably since the start of COVID-19 pandemic. So I won't go on further, but imagine there was an affordability issue right now in 2024. It's even worse right now. What I think Lawrence Yun from NAR just came up with a report. He says that the affordability crisis, or the housing affordability, is the lowest in the last 40 years. It's the lowest. So if we come back from 2024 to 2025, it's even worse. A lot of buyers cannot afford it. Those who are buying are selling and buying if they don't have an interest rate or whatever. So what's your thought on this? Is it going to get better, Paul, or is it going to get worse before it gets better?
It's a good question too. And there's a lot of people also predicting recession. So, I mean, if we didn't have a recession, if the economy kept humming along and people started getting raises, then while the prices can remain stagnant, not necessarily going up as much as they've gone in the past, but if they kind of stay level where they are, but people's salaries start going up, well, then that kind of changes the equation there too. That allows people to afford the home.
Right.
But if we do go into a recession, like some people are suggesting, the opposite's going to happen. People are going to start losing jobs. Unfortunately, salaries are going to start going down. There's going to be a lot of wage pressure on individuals. And if the prices don't adjust, then same thing too. It's just going to be even harder for buyers. They're just going to totally freeze the market.
Right.
In which case too, we'll have to see then if who blinks first. Does do the sellers start pushing their prices down harder in order to, especially those sellers who get stuck and they need to sell?
Right.
I think people who bought recently in the last couple of years, they might have bought at the top of the range and with competitive offers. Then they were, paying a premium. They're not getting much loan to value. Their equity is very little, and now their taxes have gone up. Their insurance has gone up. They may find themselves being squeezed. Whatever they originally thought they signed up for, but with insurance and taxes up, that payment goes up. Even though it's a fixed mortgage rate, your payment goes up. So now they're suffering with that. They might not be able to make those payments, and they're looking to sell. They're forced to sell because they're going upside down on their mortgage, which is painful. Nobody wants to deal with that, but that might be some of the recent buyers are probably more likely to be forced sellers if we do run into recession.
Right. And we'll talk about foreclosures. They are on the increase, but if we have time, we'll talk about foreclosures just briefly. But if you're watching live, and even if you're watching the recording after the live, make a comment. Let us know where you're from, where you're watching from, and what's happening in your local neighborhood, because what's happening in California, what's happening in Cincinnati may be different than what's happening in Montana or Utah or Idaho. So let us know what's happening. Is there an affordability crisis? Are the prices going up? Are the prices coming down? Let us know and share with us so that we can share with other viewers based on your comments. So we really appreciate comments. So we talked earlier about renting versus owning, and we one of the reasons renting is cheaper, and you touched on that, is because when you rent a property, right now, as an owner, what's happening is if you bought a house, and let me mention that if you bought a house 2 years ago, and let's say your payment was $3,000, all of a sudden you're finding out that your payment's $4,000, and lenders and realtors are getting calls, scratching their head, say, hey, my payment was $3,000. Why is it $4,000? Why is it $5,000? Why is it $3,500? That's because even though you have a fixed interest rate, your principal and interest is fixed. Your taxes and insurance, because of this high natural disaster crisis, wildfire crisis, hailstorm crisis in Nebraska, tornadoes in Oklahoma, all that has been brewing for the last 5, 6, 7, 8 years. And all of a sudden, the insurance skyrocketed nationwide, right? Because of the home values went up, all the counties and the cities are jumping and say, hey, we're going to collect more taxes. And they're increasing property taxes by leaps and bounds where it's possible, right? In California, we are lucky because of the Prop 13 in 1986, I believe, the Howard Jarvis Prop 13 limits our property taxes to 1.1% on average. Plus the increase is limited to, I believe, near CPI increase. So we're very lucky. But I hear that in some counties in Texas and Florida, property taxes have doubled, tripled, quadrupled. So if I would have bought something for $3,000 a month payment, thinking it's a fixed mortgage, and now my payment went up to 5,000. That's a reality. And a lot of them are losing their homes. A lot of them cannot afford their homes. And that's why if you're thinking about buying, a lot of people are switching to renting, because once you rent an apartment or a house for 3,000, it's going to be fixed. And you don't have, like Paul mentioned earlier, if there's any fixing to be done, let the landlord do it. So in fact, the video I did 2 weeks ago is the American dream used to be a homeowner, but now you know what the American dream is to be a renter. The 40, 50 year, I've been here 40 years in USA, the dream was to own a home. That's no more. It's gone. The dream is, can I rent? And a lot of them can't even rent because the debts are too high. So the dream is twofold. I made a mistake. It's not renting. It's paying off your debts, and then renting. So that's a new American dream. Welcome to New America 2025. Hate to be the bearer of bad news, but these are facts. It's not my creation. These are what the report says. And if you want to see the report or want to see an article, direct message me. I'll send it to you. So I want to switch some gears and talk about what's happening with the institutional buyers, Wall Street buyers like Blackstones or private equity firms. In fact, let me mention this while I'm talking about private equity firm and while I'm talking about renting. And I said the renting is a new dream. And here's another fact. There is a private equity firm that just opened up. And there's a lot of institutions, including Blackstone, including private equity firms, hedge funds. They're buying land. They're building homes, 100 homes, 200 homes. Guess what they're doing?
Build to rent.
They're not selling. They're renting. They're building townhouses, 100, 200, 300, 400, 500. They're building them. But guess what? They're not selling them. They're built to rent. That's the new trend. So let's talk about the private equity, the Wall Street, how they're affecting the affordability, because when they come and buy and they have control of the renting, they control the rent as well. So I want to share, let me see here, share a screen, because I don't want to just talk about it. I want to prove what I'm talking about. Let's see. This one is an article from, who is this from? Let's see. Private Equity Stakeholder Project. This came out on August 11, 2025. Private equity is buying up homes in Ohio. And this is just one state. A recent article in the Columbus Dispatch. Oh, you're in Ohio, right?
Yes.
Oh, well, coincidence. When Wall Street is your landlord, how institutional investors impact Central Ohio. Found that 6 corporate landlords have acquired a total of 7,000 single-family homes to rent out in Franklin County, Ohio. Where is that, by the way? Is that near you?
I believe that's Columbus area.
Columbus area, okay. 5 of these landlords are owned or backed by private equity firms. I wasn't kidding you guys. According to an analysis of property records by the paper, 2 of the landlords, American Homes for Rent and Vinebrook Homes, have been active in Central Ohio for more than a decade. In 1999, the Next Point Real Estate Strategies Fund and Access Capital Partners invested in Vinebrook Homes. I'm going to read one more paragraph and we can discuss a little bit. 4 corporate landlords backed by private equity entered the Columbus market around the time of COVID. Progress Residential, which is owned by a private equity firm, Pretium Partners, blah, 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 owned by, I won't read the names out there, too complicated, which is itself a private equity company, and Main Street Renewal, owned by Amherst Group. So the reality is, here's what's happening. These companies, these firms, these hedge funds with billions of dollars, not millions, billions of dollars, Blackstone as well, they're buying land, they're buying homes, they're buying neighborhoods. Atlanta is another one. A lot of homes in Atlanta are owned by these private equity firms and hedge funds and these private companies. They're buying them and increasing the rents because they can. So Paul, this is in your neighborhood. What's going on in Ohio there?
I actually had it maybe a year or two ago, a couple of homes that when I had listed for sale, we were approached by these, they come as, they appear as like a small LLC. And so what they would do is they would make a nice offer. They would say, hey, here's an offer on the house. And they would do like a pretty quick inspections. And so in one case, it was a rental property. And so I believe they kept the tenant in place. So the owners were happy to sell. They sold it pretty quick. And then in the other case, it was a property where the owner was living in it. He was ready to move out. And so same thing too. It was a small private equity, or appeared to be a small private equity company.
Mhm.
They paid cash. They closed quick. Seller was happy. Closed on time, and that was it.
Right. Here's a real estate agent playbook. That's Jeremy, right? Hey, say hi to. Hey, Jeremy. In Denver, the concessions have been helping with affordability. We are seeing a direct effect of the interest rate dip. The institutional buyers seem to be on the sidelines in our market still. That's good to hear. Yeah, I mean, these institutional buyers are here to stay. In fact, they're increasing. I heard some of my friends talking about forming a group and buying, maybe build 4 or 5 homes and rent it out. So it's happening at the mom and pop level because they're learning from the big boys or the big companies. So here's something from Clark. Clark, thanks for your comments. Yeah, hey, Jeremy. Yeah, it is Jeremy. I just want to make sure because it says the real estate playbook. Thanks for watching. Thanks for your comments. Hope what we're saying makes sense. So make a comments to help us if you can, if we're off the track here. But Clark is saying that these institutional investors brought a lot of down here in Atlanta, and now they are trying to unload some of the inventory and reorganize their portfolios. Okay. I'm not sure if they're dumping it at a lower price or higher price. I'm not sure, but yeah, Atlanta is a big one, just like Ohio. And let's see where it's headed. But good to hear from you, and thanks for your comments. Let's move on as far as the private equity. One more thing I want to talk about. Here's a prediction or a forecast from the experts. It says here that private equity firms, which includes the hedge funds and all the private companies, could own up to 40% of the single family rental market by 2030. That's a huge number. I mean, 40% of single family homes in USA could be owned by private equity firms, which means they will control the rental market. They will push the rental market moving out. The other thing I wanted to say, what was I going to say? Just slipped my mind. I was just about to say it. Yeah. So what I was going to say is I'm not sure of the state, but there's a bill right now is in the Senate or Congress. I don't know how that works, but there's a bill right now. I don't think it'll get passed because, well, I won't make comments on it, but let's move on. The bill is to restrict private equity firms for how many homes they can afford in a certain area. They are trying to control private equity firms coming in and buying the whole neighborhood or buying thousands of apartments or buying 100 homes. So they're trying to limit that. So the bill is being prepared. I think it was Ohio, but I could be wrong. It could be Atlanta because that's where the most of the things going on. But on the good news, on the positive news, is that there is a bill out there to restrict guys like these owning 40% of the homes. So let's see where that comes out at. I'm not sure where it'll come out. So let's see. Let me see here. Let's see. Clark is saying that they are dumping it at a lower price and messing up equity from homeowners in those subdivisions or neighborhoods. Yeah. They can dump it because if they bought each home for $200,000 and now they worth $350, and even if they dump at $325, they're making $125,000 per home. And if they have 1,000 homes, hey, you're talking over $1 million profit or whatever. I'm just reading it out. And again, Clark has made another comment. The homeowners who bought during 2022 through 2024, homeowners before that still have their equity, just not as much. That's absolutely right. Correct. And sorry, I'm writing out something to Clark here, so just bear with me here. Yeah.
I was going to add to what Clark said is that, they're dumping it at a lower price. So while the investors, they're able to do that, and they can. So for them, even if they take a little bit of loss or a bigger loss, they can write that off. Whereas the individual homeowner, if you're selling underwater, you're selling for more than you paid for it. selling it for less than you paid for it, that loss, you can't really deduct it on anything. And most likely for most buyers, they don't really have a income where they can offset that, versus like these large businesses, large private equity firms. They've got other lines of income where if they take a loss over here, they can offset it over there.
Absolutely right. On the other hand, if I was a mom and pop, which I am, and if I sell a house and make money, I have to pay property capital gains tax, which I can do in exchange. So I'm sure these guys, when they sell thousands of homes and make millions or billions of dollars, they're going to do something, or I'm sure the government will work something out with them where they can do a 1031 exchange type of a deal where they don't have to pay taxes, or they'll be limited. I'm sure they're working on it, and they've got some of the politicians in their hands. That's just a fact of life. A lot of politicians are corrupt. We know that. Nobody wants to admit it. I won't go there. I want to go there. I won't go there. It's so tempting, right? But hey, we'll talk real estate here. But the facts are facts. Corruption is out there. It'll continue. We can't prove it, but it's out there. So I said what I had to say. I feel better. Should we move on now and go play golf or something? Or I'm just kidding. Yeah. So let's switch some gears here. While we were talking about, I know earlier you mentioned foreclosures and I mentioned foreclosures. Are you seeing any foreclosures in your area, or what's your take on what's happening with foreclosures?
I haven't seen any. I've seen, I don't know if you're familiar with like the BPO process, the broker price opinions.
Right.
So I don't do those myself, but I get emails from companies that offer it. So I've been seeing a few more pop up in my emails. And so basically what that is property that's might be going into bankruptcy or close to going to bankruptcy. So the lenders will usually call up a local agent and they say, hey, can you go evaluate this property? Take pictures of the outside, go take pictures of the, the surrounding houses. What's the condition? And then give us an opinion of your value. So they want to see, okay, if this house goes to foreclosure, what is their, what is their loss, or, are they going to be able to recover money out of this? And that's why they bring in agents to do that. So especially during the housing crash back in 2002, 2007, 2008, there was a lot of agents who were doing these broker price opinions. They were going out on a daily basis. Some agents that I know, they were doing probably like, 5, 7 a day at least. Right. Sending them back. And these days it's not as many. Right. I'm not seeing as many, I'm driving around here. I do see the homes that are like vacant homes, whether they've been abandoned or they're just, somebody's sitting on it to fix and flip it. That's another story. Not like it was, back in the 07, 08 time, where you would go through neighborhoods and there would be like 4 or 5 homes that you could tell were just vacant and abandoned, broken windows, and animals coming in and out of the house. Right. So it's not as bad these days. Right.
Yeah. No, absolutely. The only thing I heard, or I read a report, I read this report back in June, is that what's happening is, especially when it comes to FHA loans, first-time home buyers, the Federal Housing Authority, what has been happening, and this is a fact, is that people who bought in 2021, not 21, but 22, 23, who bought at FHA loans, specifically buyers who had mediocre FICO score, because FHA was giving loans to people under 600 FICO score, which conventional loans usually don't give. Those people who bought with minimum down, 3.5% down, those who had 600 or mediocre FICO scores, they pushed and shoved to bring the down payment of only 3% and barely qualified, now are struggling. A lot of them are behind. In fact, up to 2 million homes are behind or having a hard time making their payments. It was about 1 million last year. It has gone up to about 2 million. And this is just FHA loans. I'm not talking about VA loans. We have issues there. I'm not talking about conventional loans because we don't have any stats over there. But the fact is, there are people struggling. Up to 2 million FHA home loan buyers are suffering. And this is just talking from 21 to 22 to 23. We're not going back. Somebody who bought in 2018 with an FHA loan, they may be struggling. This is just from the last 4 years. So that's a significant number, where 3 years ago we had 0. And now we're up to 2 million. So I don't know if you have any comment on that, or if you heard that, or Paul.
Yeah, I don't know the exact number. I know it's a high number too. And another thing I've heard is because of during COVID, a lot of these deferment programs were put in place where, a lot of people were forced out of work. They didn't want people working. They were, shut down, stop the virus type of thing. And so as a result, people couldn't make their mortgage payments. So they said, okay, we'll allow you to defer those payments. They just tacked it on to the end of the mortgage. Well, from my understanding and what I've been reading is some of those deferments, especially on the FHA, have been going on. Even on the last presidential administration, they allowed it to go on. Basically, they're just kind of sweeping it under the rug, hoping we don't have a big foreclosure crisis under our watch.
Right.
Sliding it over. At the same time, too, that also kind of stalls up the housing market. I mean, in the past where you had like a good foreclosure and at that time too, I mean, a lot of these fix and flip guys and gals, I mean, they actually did, they did pretty well because what they were doing is they would go take a foreclosure home, fix it up, and then sell it to a buyer who was ready to buy it versus now that all this inventory is just sitting there and, foreclosures aren't happening. So the market is frozen. And that's part of the thing too, when you're letting everybody pass the buck, not pay their bills, not pay their student loans, you basically freeze everything in place. And then after a while, it's like something's going to break.
Right. Yeah. Yeah, absolutely. And what was I going to say? I just slipped my mind here. I totally forgot what I was going to say on foreclosures. But anyways, I was trying to look for another thing. Here's some stats that I wrote down. What's happening is this happened in Southern California. A real estate developer bought about 120 homes, or he developed 120 homes, and he's being defaulting on it. It's on a default, and went into a foreclosure auction. There's 120 homes. So we are seeing smaller cases, but it is happening. Here's some national foreclosure spike that I was talking about. Foreclosure actions are up 13% year over year. Doesn't mean the foreclosures are up, but this includes, people who are behind, people who are in default. So the foreclosure activity, whether it's, they're behind or they're defaulted or, cannot make or trying to talk to the bank. I talked to a seller today and he said, I cannot sell because he owes more. He refinanced or whatever happened. He lost his job or whatever. He's behind on his payments. So this is happening. 36,000 properties. This is a national forecast. 36,000 properties received foreclosure filings in just 1 month.
Wow.
Doesn't mean they're going to foreclosure. People are behind, and I'm sure a lot of them will make it up or refinance or talk to the bank or whatever. Here's another stat. Nevada and Florida are leading with number one, and approximately 2,300 homes already facing foreclosure. And that hasn't happened in the last 4 or 5 years.
Yeah.
And then this report says that this is tied to unemployment. You mentioned earlier, we may be going in a recession. You mentioned unemployment. And this is for California. California unemployment rose to 5.1%. It's the highest in the nation. Wow. And I'm in California. Oh, we shouldn't talk about California. California is fine. Don't worry. No, I'll admit it. 5.1 is highest in the nation. That's what the report says. There's a direct link made between job losses and mortgage default foreclosures. Now, one thing I can tell because of California, and I'm assuming there's a lot of, especially in Southern California, especially in the Bay Area, there's a lot of high tech and tech companies. And from what I understand, a lot of these companies, Google, Microsoft, Apple, a lot of those companies have had major layoffs. So I'm assuming a lot of these are maybe high-tech layoffs. I don't know. But on the other hand, Walmart and other companies have made layoffs also. So it is a significant number, which we haven't heard in the last 10 years. But when you hear figures like these, are these big figures? What do you think, Paul? Are these big figures, small figures, anything to worry about? Or
seems like it's just the tip of the iceberg, especially if the economy stays the way it is right now, then we probably will just stay at that number. Like, if we go into recession,
right,
we'll start losing their jobs, payments, the student loans payments have resumed.
Right.
The deferments on the FHA mortgages looks like they're going to end soon. And after a while, the foreclosures are just going to start increasing by default.
Right. Yeah. Things are happening, So let's move on to inventory. We talked earlier about inventory, what's happening in the inventory. But before we do that, we have a comment from Clark. Let's address that. Clark is saying that Let me see here. Hold on. I'm trying to make my screen because I can read it. Clark says, we are seeing a small number of foreclosures down here too with homeowners, small investors, probate properties, and more. Some people have been in foreclosure since 2019. Wow. I don't know if that's a big number or not, but any foreclosure is a big number in these days. And I'm assuming the people who have been in foreclosure since 2019, maybe that's related to COVID, 2021, maybe under forbearance. But what you are talking about is what we call forbearance, right? They let you pay later and add the payments, tag it on there. But I thought that ended in 2024. I don't know. That's what I heard, that forbearance ended in 2024. So are you aware of anything like that, Paul? Or
just with the FHA, that the FHA have been allowing the extensions for I don't know how long, and
they are still okay.
Yeah,
I thought they stopped in 24.
No, I believe I think there was talk that it's supposed to stop sometime this year. I don't remember exactly, but if it does, then we'll probably start seeing an uptick in foreclosure activity.
Right. Okay. So I want to touch this again on inventory. I know earlier we talked about, and what does my title say? I want to bring it up. Price drops and housing crash begins. So here's the question. If I'm a consumer, if I'm a buyer or seller, and if I'm thinking out loud, what's happening is inventory is going up. Typically, when the inventory goes up, prices should come down, right? In a typical market. Inventory has gone up 20%, 30%, 40% significantly, right? Yet the prices are not dropping overall. I'm talking national market. Of course, in Florida, for example, inventory went up sky high and the prices actually dropped. Some cities like Naples, Cape Cod, there was other towns way up north, Florida, they drop up to 10%. And what happened was a lot of the developers, a lot of the sharks, a lot of the contractors, a lot of investors bought all those. So the inventory has dropped. So this is what's happening. So on one hand, we're seeing rise in inventory, which means there should be a price drop, but the price drop is not happening. What are some of the factors of that? I have a couple of factors we talk about, but based on you talk to buyers, sellers all day also. What's
sellers are stubborn. I mean, they want to, especially if you bought within the last couple of years, they bought at a high price. And so if they need to sell, then, they're going to say, okay, I want to sell for more than I bought it because homes only go up.
right?
Maybe within a couple of years, that's not always true. And we've seen in 2007, 2008, homes didn't always go up.
Right.
And even in this time frame too, I mean, we're still probably in the beginning of whatever this is, what you want to call right now.
Yeah.
So it's starting at this point. But if you bought last year and now you're forced to sell because either suddenly they want you back in the office, or, I was just reading, a blurb about an article in the Wall Street Journal where a married couple got divorced. They wanted to sell, but they couldn't afford to buy 2 new homes at the higher rates. They were stuck at like a 3% rate. And so they decide, okay, for now, we'll have to live together in the same house, even though they were divorced. So similar situations like that. Other places, the HOA rates are going up and people are screaming and complaining that, they can't afford the HOA amounts. So it's putting pressure on everybody all around.
Yep. Yeah. A lot of things happening. So what's happening is homeowners locked in low mortgage rates, and we talked about earlier, like 3%, hold off selling, freezing inventory, and contributing to market stagnation. So that's one of the issues we're having, is that they're putting on the market. If it doesn't sell, they're pulling it out, and they're not dropping the price. Yes, some of them have dropped prices. In fact, I mentioned earlier, 40% have given some kind of concession, whether it was repair credit, or they paid for some closing costs for FHA buyers, or they gave some, points. They paid for some points. A lot of them did a 2-to-1 buy down, on the loans.
Yeah.
Are those still happening there? What's happening in Ohio? Are there 2-to-1 buy downs going on, or are they not? Or
builders are offering much better rates. So if you're buying a new construction home, I've been seeing some builders offer like 5.99, some down to 5, depending on credit, depending on the price of the house. So the builders are still offering those types of deals, or they're throwing in like, we'll finish the basement for you.
Right.
Or will, from your basic level, all your say your appliances, your cabinets, your fixtures, finishes, whatnot, they'll up it to the better or the best, and then keep the same price just in order to help move the inventory. So with the builder's case, they have they have more stakeholders than say just a buyer and a seller, buying and selling a home. They've got their shareholders, they've got local communities that are looking, hey, you're building this community here. They don't want a half done community that actually drops everybody's value, that makes the community look bad. So that ends up not working out for the builder. So they're trying their best to keep inventory moving, to keep their people hired, because once some of these people are gone, they're not going to come back. They're going to have a hard time refinishing, finishing up these houses without the proper crews.
Exactly. Right. Yeah. Okay. Yeah. So we know that the rates dropped last week. The rates dropped to 6.29. I hear today, I didn't check it, but I heard today that the rates dropped again. There is talk that there's a fact that the Trump administration, and not getting political here, just the facts, Trump administration has been pushing, shoving, forcing Powell, which is the Feds, to drop the Fed's rate, which hopefully will drop the interest rate. So what I'm hearing is that, I didn't know this, but I just found out that when Feds indicate they're going to drop the rate, the lenders and the mortgage companies and all these lenders have already dropped their rates. That's why it's 6.29, because they anticipate and they work ahead of the time. When they drop it, I think the 16th or 17th of September, there's a meeting, FOMC meeting, right? Federal Open Market Committee has a meeting. They may drop it, they may not. So they've already dropped the rates. But what I'm hearing, according to this report, experts argue that affordability won't be restored by rate cut alone. Supply and wages must also improve. So what I'm trying to get at is, let's say to drop it to 6% or even 5.5%. As soon as that happens, guess what's going to happen to prices? It's going to skyrocket. But even at 5.9% or 5.7%, a lot of people still cannot afford. So just because the rates dropped doesn't mean they can afford it. Like it says here, the wages must improve and the supply of homes must improve. The supply of homes is still very low, right? I mean, it is higher compared to last year. How tight are they, and how much of a difference you see happening with the wages and income and affordability and all that coming along in the next couple of years? And of course, this is your intuition or whatever speaking, right? So
yeah, my 2-cent guess.
2-cent guess, right?
Yeah. So yeah, I mean, going back to it, if we see a recession, then I think things go down, and then that's going to hurt affordability even more. But if we stay where we are at now, let's say either these tariffs are successful or they're overturned or whatnot, and we kind of go back to the status quo, things don't change. We'll probably just kind of stay above water for a while here, as things kind of sort themselves out.
Right.
Eventually over time with inflation, people do get raises, for the housing prices don't go up. And I don't see them going up too unless wages substantially go up, and then maybe the housing prices will start going up again.
Right.
I think we've gotten to a point now where the housing prices have kind of gone toward their peak now. And unless people are going to get paid more, I don't see them going any higher. I mean, they might stay the same for a while, which is probably, for many people, it's probably better than than going negative.
Right. Yeah. I mean, they're not supposed to go up, but according to the prediction, of course, we're not saying that. I saw a report, according to HES, Housing Economic Survey. This is a survey done by the 100 top real estate gurus or whatever. Which includes Wells Fargo, Fannie Mae, Freddie Mac, Mortgage Bankers Association, all those guys. It's a combination of 100 predictions. They put it together. They're saying that in 26, 27, 28, home prices will go up maybe by 1 or 2% each year. It's not significant, but it's still an increase, right?
Yeah.
And
inflation goes up that much anyways per year.
Exactly.
Exactly. So it's the same amount.
So my gut feeling is prices are going to go up. They're not going to drop, especially if the rates drop, which they've already dropped 0.25%. Maybe they'll drop another point. If the rates drop, which they are going to drop, the prediction is prices are only going to go up, right, on average. So here's what Clark is asking. Clark, do you feel with rates softening, it will bring more buyers into the housing market, or do you feel people will remain on the sidelines until prices come down? I wish I had a slide. Let me look for it. Maybe Paul, I'll let you answer that if you want to answer that based on, let me find that slide while you do that.
Yeah,
And
I
I'll
think
answer that also.
yeah, I think initially buyers will come into the market, but then when they start running the numbers again, they'll be looking, okay, even with these numbers, it doesn't
Right.
make sense, because if you look at from 4 or 5 years ago, I mean, that's when a lot of the price jumps we've had, and that's also where the inflation went up, and then so inflation caused the insurance to go up. Also,
Right.
then with the rates, the housing prices going up, then taxes went up, so that's still needs to be factored in. So today's taxes are much higher, and insurance is much higher than 4 or 5 years ago. So even if you had lower rates, you know, compared from a couple of years ago, and now you've got the higher taxes, the higher insurance,
Right.
a small decrease in the interest rates, I don't know, is going to help. Once buyers look at it, they might feel like, oh yeah, let's go take a look. But once they see
Right.
the numbers, they'll be like, oh, still doesn't make sense.
Okay. Yep. But here's the slide. I found it, luckily. So it's right on my desktop. So this is Clark, to answer your question. This is a direct answer to your question for you and for the viewers that are watching. You asked what will happen to the prices, right, if the rates drop. Here's what NAR predicted. Of course, it's a search. It's what they're saying. So when the rates drop to 6%, when, we don't know if they will or not, but it's at 6.29, pretty close. It says when rates drop to 6%, 5.5 million more households will be able to afford a home. Okay. And they say that 550,000 people will likely buy within the 12 to 18 months more, right? So 500,000 more will buy in the next 12 to 18 months. But I don't know if they did a survey where it says that when the prices drop, when the rates drop, the home prices are going to go up. So we'll see what happens. But to answer your question, here's what they're saying. Definitely more buyers will buy. That may be temporary, because I can guarantee you that when the rates drop, there's going to be a flood of homeowners coming in, and the prices are going to go up. In fact, I was talking to Paul earlier before we started. We are showing a house to these buyers, putting 30% down, a lot of money down, on a $750,000 condo price range, right? And we've written or tried to write 3 offers on 3 different homes. All of them had multiple offers. So here it is. In Southern California, if the house is priced well, if it's marketed well, if it's presented well, decluttered and neutralized and everything, they're selling. So that answers your question, Clark. Let us know, for those of you watching, what's happening in your neighborhood, what do you expect to happen in the next few months, or what will happen if the rates drop. Please share with us. We'd love to hear your opinion, and share your ideas with people watching now, or people who will be watching a recording. And a lot of people watch this recording. I have more recording views than live views, because it's 5 o'clock in Southern California. People are going home, making dinner, so they watch afterwards, in the next few days. So the question is the market stuck in neutral, headed towards a slow correction, or a sudden crash? Let us know what you feel. I'll read the question again. Not a question, but what we'd like to find out, or what the other viewers want to find out. Is the market stuck in neutral, or is it headed towards a slow correction or a sudden crash? You talked about recession. You talk about inflation. We talked about wages not going up so far. We talked about maintenance sky high. We talked about insurance going sky high. HOAs going sky high. Who knows what's going to happen? We don't know. So
Yeah, it's a tough
right.
market to call. I mean, right now I would say we're stuck in neutral, and probably for the foreseeable future.
Mm-hmm. Yeah. So talking about the hidden cost, we talked about the hidden costs are obviously your HOA increases, your property taxes, your insurance, and we don't have a lot of maintenance costs to do with weather in California. But I don't know how is the weather related cost, unexpected cost, in states like Idaho and Montana, where it snows a lot, or Nebraska, where it hails a lot. Maybe you'll know more about the hidden costs. How much are there? How effective or how damaging are they?
Yeah, I mean, with the weather, especially here in like in Ohio, so we have the full 4 seasons. So when you go through those season shifts, you will see, then there's an increase in like, okay, I need to contact the HVAC technician because my furnace went down, and now I'm not either not getting air conditioning or I'm not getting heat. So especially when you get those changes, suddenly now it's no more cold, now it's hot, and you realize your AC compressor is down.
Right.
So the weather brings on that. Sometimes it's just age, but a lot of times when you get those changing in the weather, people flip the switch. They're going from AC to heating. Then also you got in the wintertime here, you got freezing if your gutters aren't properly set. If you got leaks coming in, the water's dripping in slowly, then it comes in, it freezes, and then it thaws during the day, and it can come in and actually leak into the house. So there's a lot of different things to consider in there too. And then landscaping, especially, people always have dead trees after wintertime. Trees just dry,
Right.
you'll just see them start falling over. At our old neighborhood we used to live in, our neighbor, he had one winter he had a tree just fall on his garage.
Oh,
Luckily it didn't do much damage, because I guess it was just the way it fell. It was just minor damage to the cap, and he had to call some crew out, and they had to kind of delicately cut it out so it didn't completely fall on the
right.
roof and cause more damage.
Yeah. Okay. Now, when the tree falls, is that covered by insurance or no?
Yeah, it
is?
should be.
Okay. But you have to have is there a special insurance for that?
No, generally they'll cover it. They'll cover your, if it's a tree on your property, even if it's not on your property. I mean, there's cases where it's like, you have a tree, you're in a neighborhood where there's a lot of homes close together, happens to be in the neighborhood house, it falls over. Excuse me. So the insurance companies might fight amongst each other, saying, okay, you pay, no, you pay. Ultimately, somebody will pay, assuming there's no negligence, and then we're dealing with a straightforward case. The insurance, the homeowner is living in there, and they probably declared, here's my home and whatnot. No fraud involved. And yeah, I see no reason why they wouldn't pay for that kind of damage.
Right. Okay. One of the things I wanted to bring up, which we did talk about, the maintenance cost, what's happening and why a lot of people are hit or getting behind, or why the debt is very high, is, of course, you had the PITI, but then your taxes increase unexpectedly and significantly. Your insurance skyrocketed. If you had an HOA, I'm sure your HOA increased significantly. But what's happening is, we talked earlier about maintenance, right? Every home, I've been here 25 years, so that my AC may go out, or my window may crack, or my dishwasher will go out, or something. What's happening this time around is, because of the tariffs, everything is very expensive. I'm not getting political here, but the facts are facts. And prices are going to get even higher, right? Because of the tariffs, what's happening, everything's going to go up. They're already high. There's recession coming. Inflation is high. People are losing their wages or not getting increases. But on the other hand, everything else is going up, including the cost of your regular 2x4s, or paint, or a hammer, or a tire. I just went and give away my wife's car for oil change, and they said $300 for a oil change. $300. We have to change it. It shows on the dashboard, oil changes. My wife's car. We went to give it. Pick it up tomorrow morning. It's $300 for all. It used to be. I remember going to. I'm dating myself. If you know what Jiffy Lube is, right? It used to be Jiffy Lubes. It used to be $19.99. You go in, $20. You don't have to get out of the car, and you're out. Now I have to go drop off the car, pick it up at noon, and I'm paying $300. I can't afford to pay my house payments, right? I mean, typical,
Yep, it all adds up.
All adds up, and tariff is going to add to it and cut into your ratio. Let's go back to the DTI, debt to income ratio. Lenders would like 30%, 28%, right? The front end ratio. But in LA, Orange County, people who are buying homes, the average mortgage payment in Southern California, the average is about $5,000, an average mortgage payment for people who buy today. That means you're going to make about $15,000. That's what, $125,000? What is it? 15 times 12, whatever it is. That's a lot of money to make just to be able to afford to rent or to buy. So it is becoming very expensive to buy. You hear people all the time, people are living paycheck to paycheck. No, they're not living paycheck to paycheck. They're surviving paycheck to paycheck. Sorry, I don't mean to be mean on that, but that's the fact. I know some people who bought homes and they're barely making it. They can barely make payments. You know, they're eating bread and beans every day. You know, they can't afford groceries. So anyway, we got into a negative conversation, but we want to bring out facts, you know. So any conclusion that you want to talk about, Paul, before we roll it out? Any other point that you may want to discuss or that we haven't talked about?
No, I mean, we're definitely in the interesting time cycle here, where we've got a lot of things going on at once. We've got, tariffs, interest rates are at highs, and prices for homes are at all-time highs, and buyer interest now is all-time lows. So the market's definitely going through some sort of, finding out itself, the self-discovery, if you want to call it that.
Right.
So it's going to take time. And I even see Clark's comment over there. He mentioned a little earlier, in response to your question, like what do you think is going to happen, neutral, or he feels like a slow correction, which I think that's accurate. And we were actually seeing that too in some markets, like you were mentioning, Mike, in Texas and Florida. You were seeing a slow correction.
Mm-hmm.
It's not a crash like they had in 2007, 2008, but it's correcting in some markets. So it's does it happen to the entire U.S.? I don't know. That's a good question.
Some areas doing really well, what I'm hearing, and you may know better, north of Ohio. I don't know exactly where Ohio is. The northeast states, way up there, other side of Chicago towards the East Coast, they're doing well. I hear the home prices are going up, homes are selling. I mean, what gives on that area? Is it because they're cheaper right now and people are heading there?
I think that area is, though, it's close to Washington, D.C. and Wall Street. So that's where the money is right now. So just like in your area in Silicon Valley, same thing for you guys. You've got plenty of money floating around from Silicon Valley. And then on this side here, you've got, Wall Street, and then you've got the Washington, D.C.
And all those are moving out. I hear a lot of people from Washington, D.C. are getting out of there.
I think because of the whatever Doge did and reducing the government employees, those people might be moving, but a lot of lobbyists and a lot of people who still support the government, there's still a big influx of people moving in over there.
Right. Yeah. Okay. Yeah. Well, I think we have a lot of information to give them. I've learned a lot myself about what's happening on the market. For those of you that are alive, I appreciate it. Thanks, Clark, for hanging in there. And we will be back next Tuesday. Paul, thanks a lot. Any last comment? Or, by the way, Paul is in Cincinnati. If you go to my YouTube channel, in the description, I have his website. I have his name. If you have any questions or need any help in the East Coast, Northern states, Paul will hook you up. Both of us belong to a network of top agents, not only via YouTube and Facebook, but other channels that we have. So on the West Coast, hit me up. East Coast, hit up Paul. He'll answer any questions, get you resources, connect you to lenders or attorneys or realtors. If you want to know what's happening, what the trends are, hit us up. Paul, I hope you come back when I call you again. I do appreciate it.
Yeah, thanks for having me on. And
anything you want to say, and we'll end with that.
I'm just happy to be here. Thanks again, and look forward to the next time.
Thank you all.
Thanks.
Bye-bye.